Let's get right into it. Today, in this explainer, we're tackling the single most paralyzing choice you're going to face as a new investor, trying to pick the perfect individual stock versus simply buying an index fund. If you've ever stared at a screen totally frozen, wondering exactly where to put those very first investing dollars, you're absolutely in the right place. We're breaking down everything you need to know.
So here's the million-dollar question. Should you try to pick the next superstar, hoping to catch a rocket ship like a Tesla or an Apple right before it takes off? Or should you just buy the whole market and let it do the heavy lifting for you? It's a massive decision, and honestly, getting the difference between these two approaches straight from day one is going to save you a ton of headaches, not to mention a whole lot of money down the line.
Section 1. The big investing choice. To make the right call, let's look at the actual mechanics of what you're buying, starting with the index fund. Think of it like a giant shopping basket. Take the famous S&P 500, for example. Instead of gambling on just one company, this basket gives you a tiny, totally manageable piece of the 500 biggest companies in America, all at once. You buy one unit, and boom, you instantly own a fraction of the entire U.S. corporate powerhouse. It's literally built-in diversification in just a single, simple purchase.
On the flip side, we've got individual stocks. Buying a single stock means you are putting your hard-earned money and, frankly, a lot of your hope into an isolated business. The stakes are high. If they invent the next big thing, yeah, you win big. But if they get hit with a lawsuit or miss their quarterly earnings, you take the full brunt of that hit, and there's absolutely no safety net to catch you.
Section 2. Head-to-head matchup.
Let's step into the ring and see how these two actually stack up where it counts, building wealth securely over time. Round 1 is diversification, and the contrast here is glaring. With index funds, your money is spread so incredibly wide that if one company goes bankrupt, it's just a drop in the bucket. Your overall balance barely blinks. But with individual stocks, one bad scandal, a terrible product launch, or even a CEO suddenly stepping down can completely crush your entire portfolio. You are fully exposed.
Next up, risk and return. Historically speaking, index funds reliably deliver the market average, which is usually around 7 to 10% per year over the long haul. It's this smooth, steady upward climb that compounds beautifully. Individual stocks, however, are a terrifying roller coaster. Sure, a few might soar to the moon, but the vast majority actually underperform that boring, steady market average. You're taking on way more risk for a statistically much lower chance of beating the baseline.
Then there's the time commitment. And let's be real, your time is incredibly valuable. Index funds are basically a set-it-and-forget-it system. You automate it, and you go live your life. Picking winning stocks, that is practically a part-time job. It demands hours of exhausting weekly research, poring over financial statements, and constantly monitoring the news just to keep your head above water.
Section 3. The hard truth.
You might be sitting there thinking, hey, I've got a special eye for trends. I can outsmart the market. But before you go all in on that, look at this staggering statistic. Studies show that roughly 80 to 90% of highly paid full-time professional stock pickers completely fail to beat the market over a 10 to 15-year period. Let that sink in for a second. People with massive research teams, advanced insider models, and specialized financial degrees literally cannot consistently beat a simple, boring index fund.
And here's the kicker. If highly trained professionals fail that spectacularly, regular investors fare even worse. Why? Well, because we're human. We're so prone to emotional buying, like jumping in when a stock is all hyped up on social media, and panic selling the second the market drops. An index fund completely removes that emotional guesswork. It doesn't try to beat the market, it literally just is the market. You don't have to outsmart anyone.
So, it all comes down to weighing the pros and cons clearly before making a move. When we put them side by side, the picture is crystal clear. Index funds offer low stress, built-in diversification, and require almost zero effort. Individual stocks offer the thrill of a massive upside and a cool feeling of ownership, but they bring extremely high risk, frequent losses, and they'll drain your free time.
Section 4. The winning core strategy.
Now, here's the really good news. Instead of an all-or-nothing approach, there is an incredibly effective hybrid compromise that gives you financial safety without condemning you to total boredom. The ultimate recommendation for beginners is this. Make index funds your rock-solid foundation. Put 80 to 95% of your money into a low-cost S&P 500 or total stock market index fund. Only after that unshakable foundation is set should you use the remaining 5 to 10% as fund money to scratch that individual stock-picking itch. This exact split gives you the absolute best of both worlds.
You secure steady, low-stress wealth building from your core index strategy so you know your future is protected, but at the same time, you still get to have fun picking exciting stocks with your play money, totally safe in the knowledge that you aren't risking your entire financial future if your favorite company happens to have a terrible year.
Section 5, your simple action plan. It's time to turn all this theory into reality with a straightforward, stress-free playbook you can start using today. Step 1, open a brokerage account at a reliable institution, think Vanguard, Fidelity, or Schwab. Step 2, invest your core money into a low-cost S&P 500 index fund. Step 3, set up automatic monthly contributions so you literally never even have to think about it. And Step 4, only add those individual fund stocks later, and only using money you can comfortably afford to lose. It really is that simple.
The ultimate irony of investing is that boring, consistent index funds will almost always beat the excitement of trying to find the next superstar stock. Consistency and time in the market matter way more than adrenaline or pure luck. Look, index funds aren't going to make you rich overnight, but they are arguably the most reliable path to long-term wealth ever created.
So, as you step out to finally put your money to work after watching this explainer, I've got to ask you the big question. Armed with the actual data, the hard truths, and the ultimate core strategy, are you joining Team Index, or are you still placing your bets on Team Stocks? Think carefully about your foundation, and whatever you choose, stick to your plan.